Logistics and haulage businesses don't fail because they lack work, they fail because margins get squeezed. In this video, I explain how business loans work for haulage companies in the UK and where finance helps, versus where it just papers over problems. Fuel, vehicles, maintenance and staffing leave little margin for error. Borrowing can stabilise cash flow, but it won't fix low pricing or structural margin issues. General information only. Let's start with the core issue in haulage: low margins and high fixed costs. Fuel, vehicle finance, maintenance, insurance, wages and compliance costs all add up quickly. Even when turnover looks strong, net profit can be thin, and lenders lend based on profit and cash flow, not miles driven. One of the biggest mistakes haulage operators make is assuming that more work automatically improves borrowing power. In reality, taking on extra contracts can increase cash flow pressure if margins don't improve. Lenders look closely at whether additional turnover actually strengthens the business or simply adds strain. Vehicle finance plays a major role in this sector. Many haulage firms already have significant monthly commitments tied to trucks, trailers, or vans. These payments reduce affordability for additional borrowing. From a lender's perspective, heavy existing finance can limit how much further debt the business can realistically support. Cash flow timing is another challenge. Payment terms in logistics can stretch to 30, 60, or even 90 days, while fuel and wages must be paid weekly. This gap is where many businesses feel pressure. Applying for a standard unsecured business loan to cover this gap can be risky because repayments are fixed regardless of when customers pay. Lenders also look at contract stability. Long-term contracts with reliable counterparties are viewed very differently from spot work or short-term agreements. A business relying heavily on one major client may face concentration risk. Even if that client pays on time, credit still matters, both business and personal. Even limited companies are often assessed based on director guarantees. Missed payments, arrears, or overstretched personal finances can reduce options or push borrowing costs higher. Another issue is cost sensitivity. Because margins are tight, interest rates and fees have a bigger impact in haulage than in higher margin sectors. A loan that looks manageable on paper can quietly erode profit month after month if it's not structured carefully. So what actually works for logistics and haulage businesses? First, clarity on true margins, not just headline turnover. Second, realistic cash flow forecasts that show how the business handles fuel, wages, and finance costs. Third, funding that matches the purpose, stability, vehicle acquisition, or controlled growth. And finally, avoiding over-leveraging a business that already operates on fine margins. Finance can support a haulage business, but only when it respects the margin reality of the sector. The goal isn't to borrow more, it's to borrow smarter. If you found this useful, subscribe for more straight talk videos covering business finance, sector-specific funding, and common mistakes business owners make. And if you want to explore funding options for your own logistics or haulage business, you can find more information via the links on the channel. Thanks for watching. Logistics and haulage businesses don't fail because they lack work, they fail because margins get squeezed. In this video, I explain how business loans work for haulage companies in the UK and where finance helps versus where it just papers over problems. Fuel, vehicles, maintenance and staffing leave little margin for error. Borrowing can stabilise cash flow, but it won't fix low pricing or structural margin issues. General information only.